Well, markets are nervous around the uncertainty of the post-COVID new normal, especially as it relates to fiscal and monetary policies. As monetary policy slowly normalizes around the world, some stocks in the value spectrum of the equity markets might benefit from cyclical recovery and slightly higher rates. Those will include financials and industrials, for example. The current environment is generating a half-full, half-empty framework. On the one hand, rates are still very low and economic growth is rebounding. On the other hand, fear of policy normalization and tapering are creating support for more equity upside. This will provide a context for volatility that can be a fruitful ground for bottom-up investors with a long-term perspective. The key signals to monitor on the risk side over the next 12 to 18 months are 1. Risk of policy mistakes by central banks, 2. Excesses such as pockets of overvaluation or euphoria in certain areas of the markets. But longer term, the challenges to keep in mind are geopolitics and digital Darwinism, i.e. the global competitiveness war that takes root in global tech and AI advancement, and of course climate change. Well, the best way to benefit from volatility is to have a well-diversified portfolio anchored around key pillars of long-term growth at reasonable valuation with some income support. It is key to maintain a long-term time horizon in an effort to benefit from strong bottom-up stock-picking skills. Such portfolios should include a style diversification of growth and value and income, thematics benefiting from artificial intelligence, sustainability, climate change mitigation, etc. It should also have a broadly diversified geographical exposure with some exposure to China, which is really developing as an asset class.